Instacart, officially Maple Bear Inc., trading as Cart on NASDAQ, the company that digitized grocery shopping for millions of Americans and then discovered that the real money was in advertising.
At its core, Instacart is two businesses running on the same platform, a grocery delivery marketplace and a high-margin digital advertising network serving consumer packaged goods brands.
Apoorva Mehta founded Instacart in 2012 in San Francisco with a radical idea: personal shoppers who pick and deliver groceries from the stores consumers already love. Same day, often within hours.
The pivot came in 2019 with Instacart ads. CPG brands paid to feature products in search results. Fidji Simo arrived as CEO in 2021 from Facebook and doubled down on that advertising flywheel.
Revenue splits into two streams. Transactions, delivery fees, service charges, and retailer take rate generate roughly 70% of top-line revenue. Advertising is the minority but the strategic crown jewel.
The advertising segment has crossed $1 billion annually. Its gross margin approaches 75%, far above the transaction side, making every advertising dollar highly accretive.
Group gross margins exceed 70% because ad revenue carries minimal incremental cost. The transaction side is tighter, shopper incentives squeeze margins, but Instacart has reduced its loss per order significantly.
With just over 3,000 employees running a platform served by hundreds of thousands of independent contractor shoppers, Instacart keeps its fixed cost base remarkably lean relative to revenue.
The advertising flywheel compounds as the platform grows. More consumer transaction data lets Instacart prove ROI to CPG advertisers more precisely, which drives higher ad rates, which funds more platform investment.
The competitive map in grocery delivery is intense. DoorDash has expanded aggressively from restaurant delivery into groceries with strong consumer app loyalty. Uber Eats brings global scale and driver supply.
Instacart's moat is its retailer network, 1,500-plus banners covering every major U.S. grocer: Kroger, Costco, Publix, Wegmans. Retailers that built their digital storefronts on Instacart face high switching costs.
Amazon Fresh has the prime flywheel and the most powerful retail advertising machine in the world. But Amazon competes with retailers. Instacart serves them. That distinction keeps most grocery chains firmly in the Instacart ecosystem.
CPG brands pay to appear first when a shopper searches for yogurt or cereal, buying shelf space in the digital grocery aisle. That proximity to purchase makes the ad platform highly valuable to consumer goods companies.
Instacart's platform also powers the digital storefronts of retailers who lack the technology to build their own, turning Instacart from a marketplace into the operating system for modern grocery commerce.
Fidji Simo leads Instacart. A French business school graduate, she spent a decade at Facebook leading the Facebook app before making the grocery tech leap.
Simo brought Silicon Valley product discipline to a delivery logistics company. Under her leadership, Instacart moved from a pure logistics play to a multi-product platform competing for CPG advertising budgets alongside Google and Meta.
Instacart, a grocery delivery marketplace that discovered advertising is the better business. 1,500 retailer partners, a billion-dollar ad platform, and improving unit economics show a path to durable profitability.
The next earnings report will test whether advertising growth is accelerating and whether transaction economics continue to improve, the two levers that determine whether Cart's long-term value story holds.
Instacart reported Q1 2026 revenue of $1.019 billion, its first ever billion-dollar quarter, up 14% year over year. Gross transaction value reached $10.3 billion. Adjusted EBITDA was $300 million. EPS of 57 cents beat the 39-cent estimate by 46%. The company increased its share buyback authorization to $3.5 billion. This is Charged Alpha. I'm Hudson.
And I'm Lana. Instacart is the leading online grocery delivery platform in the United States, operating a marketplace connecting consumers, grocery retailers, and independent shoppers. Revenue comes from advertising sold to consumer packaged goods brands, delivery and service fees, and technology subscription services sold to retailers. The Instacart ads segment carries the highest margins in the business. Market cap is approximately $11 billion.
CEO Fidji Simo joined Instacart in 2021 after a decade at Facebook. Her strategy has focused on transforming Instacart from a pure delivery marketplace to an advertising and retail technology platform. The advertising segment, called Instacart Ads, now generates high-margin revenue from CPG brands targeting grocery shoppers at the moment of purchase. Technology services sold to grocery retailers represent a second growth platform called Connected Stores.
Instacart reported Q1 2026 revenue of $1.019 billion, a milestone quarter, 14% above Q1 2025 and above the analyst estimate of $950 million. The revenue beat was driven by advertising strength and steady GTV growth. Total gross transaction value of $10.3 billion grew 13% year-over-year, reflecting transaction volume growth across the marketplace.
EPS of 57 cents beat the 39-cent estimate by 46%, one of the largest EPS beats in consumer tech this quarter. Adjusted EBITDA of $300 million grew 23% year-over-year, with an EBITDA margin approaching 30% on revenue. The EBITDA beat was driven by advertising mix improvement, high-margin ad revenue growing faster than lower-margin delivery fees.
Instacart Ads, the advertising segment, is the highest-margin business unit. CPG advertisers, including Procter & Gamble, Unilever, and Pepsi, pay premiums to reach shoppers at the point of purchase intent. Advertising revenue grew above 20% year-over-year, pulling overall revenue mix toward higher margins. Gross margin on advertising is significantly above the blended company margin, creating operating leverage as ad share grows.
The balance sheet is strong. Instacart ended Q1 with approximately $2.7 billion in cash and equivalents. The company increased its share repurchase authorization to $3.5 billion, implying significant capital return even as the business invests in technology. Instacart is net cash positive with no meaningful debt, providing flexibility for product investment without leveraged balance sheet constraints.
Instacart's grocery retailer technology platform, Connected Stores, is a strategic priority. The platform provides retailers with AI-powered inventory management, shopper behavior analytics, and fulfillment technology. Connected Stores software is sold on subscription contracts, adding stable, recurring revenue. Major grocery chains, including Albertsons and Costco, are among the platform's retail partners, extending Instacart's presence beyond the consumer marketplace.
Management commentary pointed to continued double-digit growth in 2026, with GTV growth in the mid-teens as the embedded planning assumption. Advertising revenue is expected to continue outpacing GTV growth as CPG brands increase budget allocation toward performance marketing platforms with measurable purchase data. EBITDA margin improvement is anticipated as advertising mix increases through the year.
Analyst reaction to Q1 was broadly positive, driven by the 46% EPS beat and the milestone billion-dollar revenue quarter. Bulls highlighted the advertising margin improvement and the buyback authorization as signals of management confidence. Most sell-side analysts have buy or outperform ratings, with price targets clustering in the $50 to $65 range.
The advertising monetization debate is central. Instacart Ads is the highest return business unit. Bulls argue it can grow to represent 40% of total revenue by 2028 as CPG brands shift budget to intent-based grocery advertising. Each advertising dollar carries 70 to 80% gross margins versus 30 to 40% on delivery. Advertising mix improvement is the most powerful operating leverage driver in the model.
The competition risk from Amazon Fresh and Walmart Plus is the bear's central concern. Both platforms offer grocery delivery integrated with broader commerce and subscription ecosystems. Amazon's data advantage in consumer behavior is formidable. Bulls counter that Instacart's retailer-agnostic marketplace model serves consumers who shop at specific grocery brands, Kroger, Safeway, Aldi, where Amazon and Walmart cannot capture the purchase.
The Connected Stores technology platform is the most underappreciated growth option. Grocery technology is a multi-billion opportunity. Global grocery retailers spend heavily on inventory management, demand forecasting, and customer analytics. Instacart's retailer relationships and transaction data give it a defensible data moat for building retail technology. Bulls model connected stores reaching $1 billion in annual revenue by 2028.
Valuation at 25 times forward earnings is reasonable for a platform with 30% EBITDA margins and double-digit growth. The $3.5 billion buyback authorization, representing over 30% of market cap, signals management's view that the stock is undervalued. Bears focus on platform take rate sustainability and whether grocery delivery margins hold as consumer spending moderates.
The bull case is advertising becoming the dominant revenue stream. As Instacart ads grows to 35 to 40% of revenue at 70+% gross margins, blended margins expand significantly. CPG brands are shifting from brand advertising to performance advertising tied to purchase data. Instacart's first-party grocery purchase data is among the most valuable intent signals in consumer marketing.
The Connected Stores platform provides a technology moat at the retailer level. Grocery retailers that adopt Instacart's fulfillment and analytics infrastructure become structurally embedded clients. Contract stickiness and expansion within grocery chains drives recurring revenue independent of consumer delivery volume. This B2B revenue stream reduces reliance on delivery fee economics that are exposed to competitive pressure.
The buyback math is compelling at current valuations. $3.5 billion in authorized repurchases against an $11 billion market cap implies up to 30% of shares could be retired over 3 years. Combined with earnings growth of 15 to 20% annually, EPS could reach $4 to $5 by 2028, implying significant stock appreciation from current levels.
The bear case starts with Amazon and Walmart. Both have structural grocery advantages, Amazon through Prime integration and Walmart Plus delivery of own inventory. Amazon's fulfillment network gives faster and cheaper delivery economics than Instacart's marketplace model. If Amazon and Walmart accelerate grocery market share gains, Instacart's GTV growth decelerates and delivery fee revenue stagnates.
Shopper economics create margin risk. Instacart's marketplace depends on independent contractor shoppers who pick and deliver orders. Gig worker regulation, active in California and emerging in other states, could reclassify shoppers as employees, adding benefit costs and administrative overhead. Employee reclassification would increase the cost of each delivery and compress the margins that make the business model viable.
CPG advertising budget concentration is a risk. A portion of Instacart ads revenue comes from a relatively small number of large CPG brands. If a major advertiser shifts budget to a competing platform or reduces spending, advertising revenue can be lumpy. Evolving digital advertising measurement frameworks and regulatory changes add uncertainty to the effectiveness signals CPG brands use to evaluate Instacart's ad platform.
Consumer spending normalization is the macro risk. Grocery delivery is a discretionary convenience trimmed during budget pressure. Post-pandemic delivery behavior has been stickier than expected, but sustained grocery inflation reduces disposable income for delivery fees. If incremental shoppers reduce frequency, GTV growth slows without a proportionate reduction in fixed platform costs.
DoorDash is Instacart's most direct competitor in last-mile grocery delivery. DoorDash entered grocery through its marketplace platform and DashMart dark store concept. DoorDash's restaurant delivery scale, over 30 million active consumers, gives it traffic density advantages in new grocery markets. Instacart's grocery-only focus and retailer partner model create differentiation, but DoorDash's cross-vertical reach is a growing competitive threat.
Uber Eats provides a second competitive reference. Uber's global reach and cross-platform advantages in rideshare and food delivery give it consumer acquisition economics Instacart cannot match. Uber's grocery partnerships, including Albertsons and Whole Foods in some markets, overlap directly with Instacart's retailer relationships. Bulls argue Instacart's depth in grocery-specific fulfillment outweighs Uber's breadth.
Amazon Fresh is the bear's benchmark. Amazon's fully owned grocery delivery benefits from integrated inventory, Prime bundling, and Amazon data advantages. Amazon willingly subsidizes delivery to grow Prime attachment. The Instacart counter, Kroger and Albertsons will not use Amazon logistics to serve their customers and cede grocery data to a direct competitor.
Instacart trades at a modest discount to DoorDash on a price-to-sales basis. reflecting slower GTV growth versus DoorDash's restaurant volume. The premium EBITDA margin and buyback support argue for multiple parity or a slight premium. Bull targets of $65 to $75 imply 25 to 30% upside. Bear targets cluster near $40 if GTV growth decelerates below 10%.
Instacart options ahead of Q1 reflected cautious positioning after the stock underperformed in the first quarter. Implied volatility was elevated relative to peers, suggesting the market expected a wide range of outcomes. Pre-earnings call positioning was modest. Bulls established positions targeting an earnings beat but were uncertain about GTV growth relative to delivery fee mix.
Post-earnings options activity surged on the 46% EPS beat. Near-term call buying targeted the $50 to $60 range as the stock moved toward new highs. Bulls positioning for a multi-quarter re-rating bought calls out to September. Modeling continued advertising mix improvement, expanding EBITDA margins toward 35%. Options open interest shifted constructively bullish after the report.
Insider activity at Instacart has been mixed. CEO Fidji Simo and executives have sold shares through 10b5-1 plans consistent with compensation vesting schedules. No significant open market insider purchases were disclosed in Q1. The board's authorization of $3.5 billion in share repurchases is the most meaningful insider signal, a formal board-level commitment to buying stock at or near current prices.
The combined signal is constructive. The buyback authorization is the dominant indicator. Management is signaling confidence in intrinsic value well above current market price. Options positioning shifted bullish post-earnings. For investors focused on advertising margin improvement as the structural driver, Q1 validated the thesis. GTV growth in the mid-teens and EBITDA margin expansion are the metrics to watch in Q2.
Instacart reported Q1 2026 revenue of $1.02 billion, its first billion-dollar quarter, up 14%. EPS beat 46%. GTV was $10.3 billion. The company expanded buyback to $3.5 billion.
Bottom line, Instacart is becoming an advertising and retail technology platform, not just a delivery marketplace. Bull case, advertising margin expansion driving EBITDA above 30%. Bear case, Amazon and Walmart eroding GTV. The 46% EPS beat and $3 billion buyback are why bulls stay long.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.